We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Bob Elliott, co-founder, CEO, and CIO of Unlimited Funds and former head of investment committee at Ray Dalio's Bridgewater Associates. Bob, thanks for joining me today.
Thanks so much for having me.
Great to have you back, Bob. And of course, we're going to have a higher level macro discussion today. But I want to maybe start by digging into your thinking a little bit about how you separate luck and skill when evaluating the outcomes of investments. It's something that I read about a long time ago. I think it was in a book called The Art of Thinking Clearly. And it's something that I go through quite a bit in my thinking of trying to understand the analysis of getting something right versus just getting lucky. So how do you go through thinking about that?
Yeah, it's a critical question. Whenever you're thinking about an asset manager, it can often be very challenging to separate that luck versus the skill. And in particular, because people can always back rationalize why they held a certain set of positions and explain why those returns came the way that they did. I think there's probably two ways in which I would think about that problem. The first way is to think about it from a sample size perspective. The higher probability that there's a much higher probability that luck has a more meaningful influence when you have lower sample size. And I think we all sort of know the stories of people who called 1 or 1.5 big shorts, and then for the subsequent 15 years couldn't make any money because they got lucky. It's not totally luck, but they were certainly helped meaningfully by luck on a small sample size outcome. And so part of the thing you want to look at is you want to look at that sample size. You could start to see and start to believe in skill increasingly when you have more and more bets that you can look at over more and more time through more and more cycles. I actually think from that perspective, the last 5 years is actually a really good time frame to evaluate a lot of managers. And the reason why that is the last 5 years, we've basically experienced every macroeconomic environment you possibly could have experienced. Mm-hmm. And so from there, you can get a pretty good sense as to whether or not the return outcomes that you're seeing, are they just simply following the market, or is there something differentiated relative to that? So sample size, across market environments and across number of bets and time and things like that's important. And then you have to link that to process. A lot of times people will just look at outcomes and they'll say, okay, well, that person called the fact that stocks were going to be up for a long, since October of 2022, and therefore they're smart. And you're like, okay, but if what their process is to just say buy stocks, is that a process? Is that luck? Versus people who can bring a compelling reason why their outcomes are repeatable, because that's what you care about. You actually don't care about what historical returns are, because they're totally useless to you. You cannot achieve historical returns in the future. So what you have to see is what is the process, because the process will define what the future outcomes will be. And that's the most important thing, pairing those two things, the empirical observation to significant enough sample size with a process. You put those two things together. If you can get something that's reasonable and reasonably reliable, then you can have more confidence that it's a matter of skill, not luck.
Mm-hmm. It's interesting that you say over the last 5 years that we have had all of these different really financial landscapes and different kind of push and pull forces that we have experienced here. So is much of how you understand how these forces acted on the markets, does that also help determine, which side of this luck/skill side of the line that you end up landing?
Yeah, well, I think one of the things you want to understand whenever you're thinking about an asset manager is you want to understand their biases. And to be clear, just because someone has a bias in a certain direction or towards a certain set of behavioral action doesn't mean that there is an edge in that bias. It just means you have to understand that bias and understand what's going on with it. And so I like this period, this last 5 years, because it's a very good period to try where you can extract and observe those biases, right? So do you see someone who, did well up until COVID and then got crushed in COVID and then did well in the rebound and then did poorly in 2022 and then is doing better over the last 18 months? Okay, well, that's a person with a long bias, right? Or, theoretically, it could be the opposite where, someone meaningfully outperformed during those weaker periods. Or maybe you see bias towards, at a level down, maybe you see a bias towards holdings related to only those companies with free cash flow or only small cap or only value and those various things. What you want to understand as an investor is you want to understand the nature of those biases, because once you understand the nature of those biases, you can then start to think, the last 5 years, but you can also start to take and understand those biases and how they might have functioned through time, right? So you can go beyond the last 5 years. If you say, just take someone who has a value bias. Okay, value, at times does well, at times does poorly, and there's reasons behind that. And so you don't have to focus only on whatever their experienced return is if you understand their bias, because then you can start to think about that bias and how it plays out in different environments. And then as you start to think about building a portfolio, you can start to think about what are the biases that you have in your portfolio of investors that you've allocated capital to, so that you're not, only holding value-oriented players or only trend-oriented players or only, growth-oriented players, so that you have that diversification amongst your manager set.
So, Bob, what do you think is a good, let's say, a good benchmark to measure against when evaluating those managers in these different economic climates?
Yeah, well, I think, of course, you want to think about their risk return. The amount of return that you're seeing relative to the amount of risk that's being taken. And you want to see the type of risk that's being taken in the context of essentially a long only portfolio, whether it's stocks only or 60-40. And so when you think about, something like the risk versus return, I think it's actually a very interesting one, because some of the things that you can see in that are whether someone is basically just has outsized returns as a function of outsized risk taking, which creates concerns that maybe, if the market went against whatever their bias is, they could experience substantial losses. What it also tells you is the plausibility that the returns that have been observed will likely continue. There's a lot of people, both in back tests, but also in reported returns, that may tell you that they have, very, very extremely good risk return ratios, risk return ratios, Sharpe ratios of 2 or 3 or 5. Such returns relative to risk are unlikely to be persistent over long periods of time, and may actually, too good an outcome may reflect too much luck being a driver. Right. Or in the extreme, may raise questions about the validity of the return profile that you're seeing, either in reported returns or a back test. And so you want to, it's almost like what you want to do on the risk return thing is you want someone who has who's giving you a plausible risk return, not someone who's giving you a bad one or a particularly good one. And then on correlation, it's just simply a question of, when you're building your whole portfolio, obviously the more that someone is simply taking risk that otherwise exists in your portfolio. So, for instance, if you're, have a lot of equity beta, you may not actually want that, because you're like, look, I got plenty of equity beta. I don't need to pay for it. It's free. Let me just, buy SPY or VTI or something like that. Versus, managers that have lower correlation to the assets that are already in your portfolio. I think the key trade-off there is that you have to understand that there's a trade-off between those two things, which is that often to get lower correlation, you actually have to have worse risk relative to or return relative to risk. And that when you start to see people say, I have essentially a zero correlation and I have outsized Sharpe ratios, that should raise questions about the plausibility of that strategy and whether it is likely to achieve those sorts of outcomes that are at least being pitched to folks.
Mhm. So, Bob, as we think about these macro forces that I mentioned earlier, maybe we could start by speaking about your views on how inflation is still too high in most developed countries, yet to justify a meaningful cutting cycle. So, how is elevated inflation yet in Europe, the UK, and the US?
Well, we've gone through an interesting period here where basically, we had a lot, there's COVID, there were supply shocks related to COVID. There was an elevation of price growth as a function of those supply shocks. And in general, developed world economies provided some sort of stimulation, some sort of fiscal support so that spending could continue despite the fact that, prices were rising much faster than wages. But we've sort of settled into a point over the, that was really 2020, 2021, and a little bit of early 2022. In the last 2 years, we've really settled into a point where wages have finally caught up with price growth, wage growth with price growth. If anything, are a bit positive, more than price growth, and are growing at a relatively elevated pace, certainly relative to pre-COVID levels. Depending on which economy you pick, it might be 1, 2, 3, or 4% higher on a nominal year-over-year growth rate than pre-COVID rates. And that's coming at a time when the structural productivity of most developed economies hasn't really changed much since COVID. I mean, there's hope, and I don't want to diminish the fact that it's certainly possible that 10 years from now we'll look back at AI and other automation strategies and say that was a great innovation. It's not in the data really today in a meaningful way. And so you have basically a lot of nominal wage growth, not too much productivity growth. And the reality is the gap between those two things is basically has to be what structural price growth is, which is, if I pay somebody a certain, if someone's nominal wage is growing at a certain pace and their, per hour, let's say, and their output per hour is growing at a meaningfully slower pace, then the gap between those two things basically has to be resolved through changes in prices. And so that's essentially what we're seeing across the developed world. In the US, we've had flat productivity for the last couple of years, and nominal wage growth is growing at 4 or 5%, depending on how you think about it. We've had the same is true in Europe. 3 to 4% wage growth, flat productivity. The UK actually wages growth is even higher, and so it's not surprising that we're seeing inflation that continues to be elevated relative to what those central banks' targets are. And that without resolving sort of that core thing, either productivity has to rise or wage growth has to slow in order to resolve the structural inflationary pressures, or we'll sort of stay here where we're at, which is, it's not like inflation the way it was 2 years ago, but inflation is still above where those central banks' mandate exists.
So, when we think about that mandate, Bob, obviously we most people should know that the inflation target is 2%. Why is this the target? Why is, a 2% destruction of your purchasing power per year? Why is that the target?
Yeah, I think it's a really good question. And one that it's not arbitrary. I think some people will look at that and say 2%, it's arbitrary. And I think that's not quite right. Like, the idea of the 2% target, and to be clear, really what it's intended to be by design is a 1 to 2% target, is that you want to have a little bit of inflation in an economy in order to prevent a deflationary debt spiral dynamic, which, is the sort of thing that we saw in Japan. And what that means is, if we have a circumstance where, say, prices are deflating and you have debt, it means that your income, debt is fixed in terms of nominal value, and incomes typically rise over time. And so if what happens is your incomes are falling and your debt stock is staying the same in terms of its valuation, that creates a squeeze on you, right? Your debt burdens are outpacing your income. It also has a growth impact, which is, if you knew, say, you were thinking about buying an iPhone, right? And you were like, hey, look, I know that the iPhone, I can buy it for $1,000 today, or I can wait a week and buy it for $750. Well, what would you do? I mean, your time value of money is such that you would clearly wait a week to save $250. Now, that's a stylized example, but it's the sort of thing that creates a concern in an economy if you have a persistent deflationary dynamic, which is people will delay purchases on expectations of future lower prices. And that is on net bad. So you want to have just enough inflation to prevent those two main points from occurring in an economy over time. And so that's where you want a slightly positive inflation rate, and you want to be able for it to move around, because sometimes oil prices go up and they go down. And so you want a little bit of wiggle room above zero. The main thing is what you don't want to have happen is you don't want to have it go, so high that it starts to create uncertainty about what future inflation is. And this is a bit of a mind game. And so it's not, it's less of a principle in fact, the way those deflationary dynamics are, and more of a question of how do people respond. And the reality is, if you look back through time over the course of the last 100 years, what tends to happen is that the rate of price rise increases of 1% to 2%. Typically, people don't meaningfully change their behaviors as a function of that, or demand higher risk premiums on investment as a function of that. But when you start to get something like 3 or 4 or 5, that's when you start to see behavioral aspects where inflation expectations start to become a much bigger driver of people's economic behavior. And you can see that empirically in how the correlation between stocks and bonds starts to change as you go from modest inflation, 1% to 2%, to 3% to 4%. And you can also see that, you can observe that in the experience in the sense of the odds, if you get it, the odds, if you have inflation at, say, 3% or 4%, the odds that you get inflation at 5% or 6% are actually relatively high, given the higher you have inflation, the more volatility, the more likelihood you have, even more elevated inflation. And so that's really what you're trying to avoid.
So, you bring up this idea of deflation, and, when we think about how that would change the time preference for how people use their currency, it doesn't seem to me that if you wait, a week, it'll be $250 less. If you wait 2 weeks, it'll be half as much. There's going to be a point at which you need to buy that phone. And there's also going to be a point at which the phones won't be able to be produced for that price. So, inherent in that, I feel like there is a floor somewhere that is going to need to be met by both the producers and the consumers. And in my mind, it doesn't really make sense that we should be so scared of deflation from a consumer aspect, but yet why are central banks and in these developed countries so afraid of deflation itself?
Well, I think part of it is the first point around the income and debt dynamics it's probably the biggest risk if you're sitting in the state of a central banker, because that creates a negative reinforcing cycle where incomes are too low relative to debts, which makes borrowers less creditworthy, which gets debt pulled, which raises the cost of borrowing, which creates a harder time, even more pressure on debts and debt service, et cetera, et cetera. And so that, I think, is probably, from a central bank's perspective, the most concerning point. And in fact, I think if we were in a circumstance that you're alluding to, which is if we had a productivity-driven disinflationary environment, let's say, that I think a lot of I think there's good reason to believe that could be an acceptable state or outcome, at least for a period of time, where in that case, that would the productivity part of it would actually resolve the debt risk, because what would happen is incomes would rise, prices might fall, but incomes would rise relative to existing debt stocks. And so you wouldn't have that debt deflation spiral dynamic that might occur. Now, you could, of course, still have a bit of the delayed spending thing going on, and as you say, that does exist in the economy. Like, I don't know, think about televisions or whatever. Like sometimes you'll wait for the next model year or whatever, cars, or just things like that in order to get slightly lower costs, or on a hedonic adjusted basis, a better product for the same cost or a lower cost. And so it's not necessarily clear that that is uniquely terrible uniquely bad in a positive productivity driven environment. Mm-hmm. It's really about the debt relative to the incomes. That's the concern.
Right. So all of this brings up the idea between the differences of a credit-driven economic expansion and an income-driven economic expansion. So can you lay out the main differences between the two for our listeners?
Yeah, I mean, most of us have only experienced credit-driven economic expansions. And so when you think about a credit-driven economic expansion, what that means is someone is borrowing, from a bank, or other source of lending. And they're using that money to supplement their income and increase their spending or investment. And so the classic one is like the housing bubble, right? Which is, basically a lot of people borrowed a lot of money and bought a lot of houses. And there was a fair amount of economic activity associated with that, as one might expect. And the trouble with that, with the borrowing driven expansion, is that there are limits to the amount of credit that can be taken on by a household or a business, in particular related to their cash flows. And if you look at the U.S. housing bubble, first we had 80 LTV loans, and then we had 100 LTV loans, and then we started paying people to take on loans, right? And then eventually we got to the point where we've exhausted we found every borrower in America who could take a loan. And we saddled them with incredible amounts of debt. And we were like, okay, well then what else can be done? And the answer is not a whole heck of a lot, right? And so that's when in some ways, debt cycles exhaust themselves, because at some point you basically have lent to all the creditworthy borrowers and often then some. And at some point, there are no other borrowers that you can plausibly lend to. Plus the balance sheets of lenders start to become constrained, and that combined with an interest rate tightening creates a downturn. So what that highlights is a credit cycle creates an unsustainable buildup of liabilities and credit that can't continue for forever. Now, an income-driven cycle is very, very different, because it doesn't create those unsustainable imbalances. And to make that cycle, to simplify that cycle, basically imagine there's just you and I, and what happens is, I paint your house and you give me $100, and I take that $100 and, give it to you, and say, hey, can you mow my lawn? Just that simple. Both of us have engaged in economic activity, the painting and the lawn mowing. Both of us have more income, right? Because what happens is, I got $100, you got $100, right? And both of us have improved have gotten a real benefit, right? You got a painted house and I got a mowed lawn. Mm-hmm. And what is the wake of that? There's no wake of it. There's no unsustainable buildup. We just sit, you have $100 in your pocket that you had at the start of it and nothing else, right? And we have a mowed lawn and a painted house, mm-hmm. and we're feeling good about ourselves. And so that's the way a income-driven cycle works, and that can happen in a very sustainable way, and it can happen, for an extended period of time. Just think about that, that cycle that I just described, and of course that's a toy example, but it kind of gives you a sense as to kind of how it works. Often people will say, well, you have to have let's say an inflationary spiral. It's there's no inflationary spiral here. It's just I paint your house, you mow the lawn, and that's what we do. And then theoretically we could just do it the next year and the next year and the next year. No problem. Right. And, maybe we do something a little bit better than what we did the previous year. And that's what growth is. Right. And that's basically how that cycle can persist. And so you need, in that sort of environment, because it doesn't have that natural, two important points. One, interest rates in what I just described could be 1,000%, or they could be zero, and it would have actually no effect on this transaction between you and I. No impact,
because nobody's using credit.
Because no one's using credit.
Yeah,
it doesn't matter. Now, of course, that's a little, it's obviously overly stylized, but it kind of gives you a sense in economies with very underdeveloped credit systems. This is actually this is basically how economies expand and contract, and what ends up creating the eventual downturn is is either an exogenous activity, an exogenous force like COVID or something like that, that causes us to stay in our homes and not produce economic activity. Or what starts to happen is we start to invest a little bit too much on expectations that will continue to grow that don't become realized. And then eventually we slow down that investment, because one of the things that could happen is, as I, paint your house and get the $100, I could go invest in more painting equipment and things like that, which has its own GDP effect. And if I don't actually see the end demand that comes in the next year and the next year and the next year, I may slow my investment. And of course, you spend the $100 at the hardware store, and the hardware store gets the money, et cetera, et cetera. And so that's often how those cycles work. But you need something exogenous. There has to be something different that's coming from outside than just the actual transaction to slow that sort of economic expansion.
Mm-hmm. So does or can a credit-driven growth cycle lead to an income-driven cycle as wages catch up to this new amount of credit in the system?
Yeah, it's an interesting question, and I think one in which if you sort of go if you go back through like U.S. cycles back in the 50s and 60s, what you had was a mostly income-driven cycle, but the let's say the turns were supported by credit, in the sense of, when you had a decline in interest rates, you had people looking at that and saying, well, I can borrow a little bit and engage in some economic activity, borrow to buy a car or something like that, to engage in a capital transaction. And that sort of creates a bit of a spark, which then starts to create, someone sells you the car, that's their income. They take that income, they spend it, et cetera, and it goes through the economy. And so in some previous cycles, in sort of old time cycles, you had modest shifts in debt, creating that income generation, but it was really the income expansion that was the big driver, once that sort of spark happened in the economy, which is different from, I think, as you got to something where, like the 2008 cycle, that was a cycle where essentially all the volatility of economic activity was driven by marginal borrowing in one form or another. And so, we transitioned, it doesn't mean that there's no income, because obviously people have income,
Mm-hmm.
but the question is more what drives the volatility rather than what drives, the absolute level of spending.
Mm-hmm. So to counterbalance this positive force, Bob, when we see the government deficits that the US is currently running, how persistent must they be to affect that growth?
Yeah, it's a good question. I think often people will look at deficits and they'll think a high level of deficit or a high level of spending creates a lot of growth. And I think the challenge with that is that it doesn't actually translate. High levels of deficit and high levels of spending don't actually translate to more growth in general. And
Mm-hmm.
again, to go to a sort of toy example, if there's a simple government that borrows and then engages in transfer payments, let's say in year one they borrow 100 and they do a transfer payment to somebody for $100. That person's income is essentially $100, and they can spend $100, and the deficit is $100. If in year two they essentially do the same exact thing, which is they run a $100 deficit, they borrow $100, they hand it to somebody, it's $100 of their income, and that somebody spends it, the spending is still at $100, right? So we've had deficits, equal large deficits for both periods, but the spending amount has remained largely constant, because the income the level of the income has remained constant for somebody receiving those transfer payments. And so I think that's one of the challenges when you think about government debt and deficits. What you can do is a stable, large level of deficit doesn't actually create a lot of stimulation, economic stimulation in the economy. It creates a lot of debt, and that debt has to get paid back, right? And so that's a big overhang, and that large amount of borrowing can have influence on, say, the interest rate markets, but it doesn't create a lot of economic activity. And so if we look at the US context post-COVID, we essentially had a huge surge in borrowing, right, during and after COVID, and a variety of different transfer payments that happened. Those transfer payments essentially created the helped finance the gap between when wages were not going up nearly as much as prices to the point where wages were going up nearly as much as prices. And then what happened was the government deficit came down as the private sector wages started to rise. And then what's happened is basically the US government's deficit has remained flat at a significant level over the course of the last 2 years, which means that it hasn't had a lot of GDP support. I mean, from a growth perspective, it hasn't had a lot of growth support. There's been a lot of borrowing, and mostly income has been driving the rise in GDP over the last, 18 to 24 months.
So, Bob, when we think about, these, let's say these countervailing forces of inflation, what are some of the forces that are still driving inflation higher on the positive side of the scale? Are we seeing, an absorption of goods and services pricing on the growth of the money supply that was added since COVID?
Yeah, I mean, I think in a large, diversified, service-oriented economy like the U.S., a big part of what drives inflation is services prices, and those services prices, it's the services cost relative to the productive growth of creating those services. And so I think when you look at the US case in particular, we had a lot of the initial inflation was goods oriented inflation. Supply shocks created a squeeze in goods, used cars, new cars, furniture, just all sorts of stuff like that, which went up a lot. And also because we were in COVID, our consumption pattern shifted a lot to those goods because we weren't engaged in, service-oriented activities nearly as much. And so that created a squeeze on those prices. But as the supply chains have been mostly resolved there, meaningfully resolved, we started to see those prices certainly rise less. And actually, many of those prices have been actively falling over the course of the last couple of years. That has been a negative. I mean, a negative meaning a beneficial drag on inflationary pressures. But what's happened is wage growth has continued to, has picked up during that period, and wage growth basically defines services inflation. Like if you're engaged in a very straightforward services, let's just say lawn mowing again, what is the underlying cost structure of lawn mowing? I mean, it's basically like gas, although that's a relatively small amount in the scheme of things, and the labor costs. So if wages are going up 5% a year, then you basically have to pay, you have to ask for more 5% a year increase in prices. That's just how it goes in order to maintain your margins. And so I think that's basically what we're seeing in terms of what's creating the structural, important structural support to inflation being elevated is just that sort of in many ways very boring, like, wage inflation is price inflation. That's just how it goes.
It becomes price inflation.
It just becomes price inflation.
Yeah.
Right. Because otherwise businesses margins would be hit. And there's been a little bit of a story, particularly with big businesses where their margins haven't really been hit. But if you're and they've raised their prices in excess of their labor costs for like S&P 500 companies. But like if you're literally a lawnmower, a lawnmower company, like it's pretty straightforward in terms of what your costs are relative to what the prices that you're charging people.
Mm-hmm. And then what? Again, I think there's a lot of good, let's say, symmetry or ways to explain and paint this picture of a lot of these things that we're talking about today by really using a scale. So on the other side of that scale, what are some of the big deflationary forces that have helped temper these hotter PCE numbers, for example, that we've been seeing over the last couple of months?
Well, I mean, goods and capital goods in particular have benefited from a fair amount of disinflation or deflation over the course of the last 12 to 18 months. And so you think about something like used cars, used car prices,
well, right?
Yeah, used car prices, rents have moderated. The the price level hasn't really changed, but the pace of price growth has slowed. In part, something like used cars or furniture or other things has been a function of supply chains starting to get resolved. Something like housing and particularly rents, has benefited over the course of the last 18, 24 months from a significant increase in supply, particularly in those hot Sunbelt cities where you're seeing, a lot of multifamily apartment supply, basically at secular highs, which has brought a lot of supply into the market, which has helped depress rents, bring rents down or bring the growth of rents down considerably. And so, those in a lot of ways, that's like, any price is just a function of supply and demand. And in a lot of ways, what we saw on the goods side, as well as to some extent in the housing side, is an increase in supply that has helped create, has helped bring down price pressures.
So,
and the problem, actually, I would just say, and the problem is with goods and houses, you can produce a lot more of them. The problem is with services, it's actually pretty tough to produce a lot more of them, at least on an 18-year lag, right? In terms of people getting into the workforce. Or
even just training new skilled labor too, right?
Exactly, right? And so I think that's where the supply problem, if you're going to think about it from a U.S. economic perspective, is that we have a labor supply problem. So we still, in some ways, the inflation problem is still a supply problem. It's just a labor supply problem, not really a goods supply problem. And so, and that's been exacerbated post-COVID for a number of reasons. I mean, one, there was actually, a fair amount of, let's say, post-COVID illness-related reduction in productive capacity by millions of people, basically, in one form or another. And then on top of it, there's been an increase in excess retirements that has far outpaced what expectations were, a few million of those. And so, you've pulled like 6 million people out of the labor market over the course of a couple of years. That's a pretty big impact in terms of thinking about labor supply. It's pretty hard to find 6 million people to come into the labor market, particularly the skilled labor market, with any, at that pace or that rapid an increase in labor supply.
Mm-hmm. Bob, as we think about this idea of the cost of labor, is reshoring a big part of this continued rise of inflation? It seems to me that considering the cost of building new plants abroad and adding the labor, and especially the skilled labor that is difficult to find, as we just spoke about, that seems to me like a cost that is eventually going to be passed on to the consumer that will only add to this inflation of goods prices.
Yeah, I think anytime you go through a period of globalization, the whole point of globalization is find the lowest cost producer. And we've gone through like 30 or 40 years of finding the lowest cost producer very, very successfully. And so a process of deglobalization and in particular creating parallel supply chains in one form or another, essentially is just saying we're going to create supply where there is that is not as low cost as the supply we would otherwise choose to have. And that's not to say that it's necessarily a bad decision to do that. There's lots of, let's say, non-economic reasons to do that. From a defense perspective, a domestic resiliency perspective, et cetera, in terms of economic growth. There's also growth benefits to actually doing that. If you build factories, you put people to work, and that is absolutely beneficial in terms of when you're thinking about U.S. conditions. A big part of actually why U.S. economic conditions have been so strong has been a lot of business, non-residential fixed investment, factory building, like you're describing. And so, that's a positive growth outcome. The issue is it's also inflationary. And so that's the trade-off, is that, you can have things like onshoring, building factories, duplicating supply chains, the benefits that come with that. It's just you're doing so in a way that creates more price pressure. And so that's just a trade-off when you're thinking about it from a policymaker perspective between, say, for instance, geopolitical independence relative to the fact that prices might be, price growth might be 1% higher. That's just that's a political trade-off, not a there's no sort of macroeconomic truth to that. There's just a political trade-off that exists when you're making those decisions.
Right. How about shipping costs? How do those fit into this puzzle as well? Does the conflict in the Middle East really add to this cost curve?
Yeah, I mean, shipping costs are typically not a huge component of overall costs, on the order of a few percentage points, for like a shipped light good from Asia into the United States. Part of the biggest issue on shipping disruptions is that if you think about like demand is, if you think demand is relatively constant, let's say, and you get shipping disruptions, let's just say you get supply that typically takes 8 weeks and now it takes 16 weeks or something like that to come into the market. That actually creates a real problem because people keep demanding it and demanding whatever the goods are, and the supply is actually delayed. And if we were sort of always delayed, then you'd start to build resiliency around that level of delay. It's just when there's unexpected delays that means that there's then just functionally like less stuff on the shelves, which functionally means that people charge more, which creates a squeeze on prices. And then of course you get these bullwhips where you get inventory drawdowns and price increases, and then finally they sort of resolve the supply chain, and then prices, go from going up to going down, and demand starts to, reflect that as well. And so that's one of the confusing things about it is you kind of get these bullwhips when you get this interference. And so the general point of, the IMF actually did some very good studies on like what the incremental impact is of, let's just say, national Trans-Pacific shipping costs go up by 100% or something like that. The impact on goods prices is like, 0.5% or 1%. That's not the big story. It's not the big story. The big story is the disruption.
Probably because you can, spread that cost out over so many units, right?
Right. There's so many units and it's just not, the transport cost is just not that high in the scheme of things. And that should make that should be intuitive because like it is kind of wild that we can, that we produce things in Asia and then put them on boats and have them take weeks to come to the port of LA and then, distribute on trucks and trains and then distribute, relative to producing them in our backyards. And so the shipping cost must not be the big thing, right? Because otherwise, if it was a huge input cost, it would cause, we wouldn't be producing nearly as much offshore. And so it's really about the changes in it. And those changes, they were substantial during COVID. And just the rerouting of the ships, away from the Suez Canal is like certainly disruptive at a minimum.
I remember seeing recently a video of how long it would take to pay off, one of these massive container ships that's worth, several $100 million, like $300 or $400 million. And, you initially look at the sticker price of the ship and you think, man, it's going to take this company years and years to pay this off. And it's like, once you actually work out how many containers and how many units, as we're talking about this particular example, the economics of it actually work out in like 2 trips. It's unbelievable to think about.
That's wild. I think the only sort of core risk of this, which sometimes people don't fully appreciate in the shipping dynamic, is there is an elasticity issue with shipping, which is it takes, let's just say, I don't know, it takes like a year or 2 to build a ship, like a huge container ship, which means that if we start to get to capacity constraints in container ships, and there are capacity constraints, again, going to that length of time, the length of time is actually a real problem because imagine instead of every good traveling in 4 weeks, it has to travel in 8 weeks. Well, then, to oversimplify, you would need twice as many ships on the seas, right? to deliver the same amount of goods. That's a general, a toy example, but it kind of gives you an intuition around it. And so, and because the goods that are sitting in the port of Shanghai are worth essentially zero in Shanghai, and they're only worth capital if they're sitting in the port of LA or Long Beach, the elasticity of shipping prices are way more volatile than, goods prices, because if there's a constraint on the supply of ships, then, you're out there bidding your ship because you want to get your good, on the Trans-Pacific, and delivered into the market. And so that's why you see such huge volatility. 100% price increase in shipping costs is not unusual by any stretch.
So, Bob, going back to, really the cornerstones of, in a way, the Fed's verbiage of always being data dependent, right? We see the labor market being very tight, and we see stocks being at all-time highs as well. So do those factors point really against the Fed cutting rates at this point?
Yeah, and I think if take away all the noise of what's going on today and COVID and all that stuff, and I just said, look, I got an economy. Unemployment is at multi-decade lows. Growth is, at potential, roughly has been for a couple of years. Inflation, was quite elevated and it's still a bit above target. And, interest rates were raised, relatively swiftly, but have basically been the same for the last, year or two. You'd say, hey, what should you do with that economy? Cutting hundreds of basis points is certainly not the opening bid that you would have, given that fact pattern, right? Probably the thing you'd look at is you'd sort of say, maybe neutral, maybe a little tighter, given that, growth okay and unemployment's still pretty good and inflation's still elevated. Like that's kind of where you would, and you've had elevated rates for a period of time and those are working through the system, but don't seem to have done enough quite to actually slow the economy, to slow inflation. And so that's kind of, you have sort of a tightening bias, I think would be the basic picture given that set of circumstance. And so, the idea, I think there's central bankers will often talk about expectations of doing lots of things into the future. And what they actually respond to is what the data looks like. And they typically respond to what that data looks like in a pretty normal way. And so as a result, actually, given this set of circumstances, it's not that surprising that we've gotten to a point in the market pricing where basically there's no cuts priced in for the year from the Fed's perspective. We're basically, at or close to zero cuts depending on, the particular day. Totally aligns with the macroeconomic data that we're seeing.
Bob, do you think there are pieces of the labor market numbers that are worth, digging into a little bit more, such as, if somebody loses a full-time job, but let's say gets 2 part-time jobs, this is noted as a net increase of 1, but likely doesn't come with the equivalent benefits or compensation that the full-time job did.
Yeah, when you think about it, labor markets, I think and really this goes with any macro data. I think, there's a lot of different pieces of information. And then on top of it, you have to think about there's noise in that information that you're getting to. And so your best approach is to look at kind of all the data and kind of get that weighing machine out to sort of say, what is the aggregate picture that it's basically telling me? And so you're right. If I were to see, declines in full-time labor, full-time jobs and rises in part-time jobs, that's certainly less structurally beneficial than if it was predominantly in full-time jobs. At the same time, you look at wage growth, you look at layoffs are very, very low. I mean, basically as low as they've been in decades. So there's other cross-cutting things that you're seeing that you want to triangulate to get a sense of the overall health of the labor market. And so, very, very often, actually, whatever, next week is our labor data extravaganza. A lot of times, people will try to point to one particular series, temp hiring in Nebraska is the thing that is the leading thing for the whole economy? And the answer is like, no, that's not right. Like what you want to do, look at all the data and sort of get that general picture. And when you get that, when you look at all the data and you get the general picture, you said, you know, labor market's pretty healthy, you know, pretty tight relative certainly to history.
Mhm. So what does this in turn mean for, you know, this interest rate environment and this all of these things that we've talked about today? What does this in turn mean for the bond markets in these developed countries, especially on the long end?
Yeah, so we've seen over the course of the year a bit of a repricing and recognition here of the fact that we're probably not going to see the magnitude of cuts that were hoped for coming into 2024. And that sort of repricing has brought bond markets higher, and the pushing out of cuts has brought yields in aggregate higher, though that's mostly been a reflection of the fact that people shifted their expectations of growth. So like coming into 24 in the US, actually growth expectations were less than 1% real growth over the course of the year, which is pretty weak in the scheme of things. And that's now shifted. And, you know, economists' expectations, which, you know, aren't perfect, but kind of give you a sense as to what people are thinking, are now that growth in the second through fourth quarter is going to be above 3% real. 3% real growth in the U.S. economy right now is pretty strong. You know, I'd say that's quite a healthy growth rate. That's mostly been, that shift was in part what drove equities higher. But now expectations are very elevated. And it's what in part drove, you know, the 2-year interest rate to be higher than where we were when we started off the year, the short end of the curve. The long end of the curve is very interesting, I think in part because we still haven't, while yields have moved up, it's mostly been a function of the repricing of short rates, not really a repricing of what we call the term premium. So that's the amount of expected return that you receive from holding longer term bonds relative to shorter term bonds. And that's typically driven by sort of the big picture macroeconomic environment in terms of expectations of growth and inflation. And, you know, right now still remains basically at a 15-year average level, at, depending on your model, roughly a 0 term premium in bonds. And that's unusual, considering the fact that, you know, growth today is a lot better than it has been in much of the last 15 years. And inflation is certainly elevated to where it's been in the last 15 years. And so that's really the place where you haven't fully seen the repricing of higher growth and inflation expectations get priced into the markets. I think in part because people are looking at nominal yields and saying those nominal yields look pretty high relative to what I know. And I think in part the fact that the rest of the world has been a bit weaker is creating a lot of demand from those investors for higher yielding US bonds, though that has starting to fade as those economies are not nearly as weak as what people have expected.
So what do you think explains how the US avoided a recession in the last year, like many were predicting? And what is that? How do you see that resilience going forward?
Well, I think it really comes back to that income-driven dynamic and income-driven cycles. I think too many people thought we were in a credit cycle and didn't recognize that we were in an income-driven cycle. And so they looked at the sharp rise in short-term interest rates in particular and said, hey, look, we've got to have a recession because whenever there's a rise in rates, typically we have a recession. And that's totally right in a credit-driven expansion. But we had this income-driven expansion, which, you know, it's the reasons for which we've talked about already to some extent. And that created a lot of resilience. We have a very resilient US economy, I think in part because of we had a big restructuring of particularly households and businesses following the global financial crisis, where, borrowing is just much less of a big part of the day-to-day equation in terms of how people finance their spending. And so that's created a lot of resilience. the annoying thing for the Fed is it's created a lot of resilience, but it's also created much less sensitivity to monetary policy. And so what's happened is it's almost like the flip side of the benefit is the challenge for the Fed. And so I think that's basically what we've seen and been an important driver of that. And I probably would be remiss not to at least acknowledge that part of the reason why we could get to this income-driven expansion was the fact that there was so much fiscal intervention in the COVID period, in the immediate post-COVID aftermath, that helped bridge that gap in terms of incomes between a period where prices rose a lot and until incomes caught up, income growth started to catch up. And so that put us on a path to then get, that was over the course of a couple of years, which then put us on a path to then be able to have this income-driven expansion that we've seen.
Bob, in an income-driven expansion, and when you and I were speaking earlier about these times of seeing higher, 3, 4, 5% interest rate cycles or periods, does that can we also see a shift from growth back to value in these times? We've been in this environment, let's say, for the past 10 plus years, where much of this, as you're saying, was much of this growth was credit driven. Yet now, if we switch that dynamic to being back in an income driven environment, does that also kind of shift the bias towards investable assets back to back to value versus growth?
I think part of the story is from an asset return perspective, it really comes down to where are the earnings, and in some ways, where are the earnings and where do people expect the earnings to come in the future? And part of the story here is that the durability of the growth-oriented sectors in the U.S. economy and their ability to continue to get earnings growth is reflective of the fact that sort of the income cycle has diverted a lot. Income-driven cycle has actually diverted or channeled a lot of capital to that particular cohort of companies that are consolidating, and that's quite a bit different than like in the tech bust, which is another credit-driven cycle. What happened was you had a lot of companies that weren't generating cash flow. You had a lot of borrowing, corporate borrowing, to do investment in the new tech, and a lot of companies with negative earnings, basically, or non-existent earnings. And so that was that, and then a lot of hope that they would eventually get to positive earnings, right? That sort of constellation of things created very high outperformance of growth stocks for a period of time that was truly unsustainable. I think the challenge right now is that the growth stock, if you want to describe it that way, outperformance is more fundamentally driven, not entirely, but more fundamentally driven, a lot more fundamentally driven than it was during that tech bubble. And so it really the outperformers here in this cycle are really going to come down to who earns the most, revenue and capital and earnings from the expansion, and where, who is consolidating that gain and increasing market share on an economy-wide level relative to those that are not. Then, of course, all of that relative to what's priced in. And at this point, part of the challenge with the Mag 7 is they had a good run until people started to price in an extraordinary run, right? And, it doesn't necessarily last forever.
Mm-hmm. Do you look at the cycles of investment versus underinvestment in particular sectors, like let's say energy or metals, and how that ends up affecting how those businesses are run and how that ends up affecting their growth, their income, their bottom lines?
Yeah, well, I think for a lot of, particularly for resource-oriented companies, there is a sort of natural super cycle when it comes to investment and production. And a big reason why that is that the lag times are just so huge, so long, right? From the point in which you break ground to the point in which you receive production. In some cases, it can be 10 years, right? From the starting to the permitting process to the point in which metal is coming out of the ground. And so in that sense, the supply dynamics are relatively fixed and relatively well known ahead, and undulate with a 10-year lag, whereas demand, it goes up and down, it moves with the business cycle, which is a much shorter oriented cycle. And so that creates a big mismatch between the projected production and the demand, sometimes on the upside, sometimes on the downside, right? Sometimes there's way too much supply relative to weak demand. Sometimes there's not nearly enough supply. The reality is we went through, 15 years of very weak commodity prices. Really, commodity prices basically peaked at, just before the financial crisis, and have been, were soft. Like CRB was basically soft for 15 years afterwards, and only recently started to get close to where those tops were back prior to the financial crisis, which has then meant that there's been basically no investment, no investment in supply, which means that, now today we're living in the resource world based upon the investments that were decided 10 or 15 years ago when prices were falling, which means we don't have enough supply relative to the investment, which is the type of circumstances that create a squeeze on prices, and create that sort of super cycle higher. And so I think we're sort of, in the grand scheme of things, early in that super cycle rather than later in that super cycle, given the shifts in demand that have occurred across a lot of different assets. And when you look at these things, we talk about orange juice, we could talk about copper, we could talk about cocoa, we could talk about all these things as if they're idiosyncratic things. And of course, there's idiosyncrasies in each one of them. But it's important not to lose sight of the fact that there's a structural story here, which is that, basically bad price performance for 10 years in commodities has now led to a dynamic where we're having much better price performance in the future.
Mm-hmm. Yeah. And I think the important part is being able to kind of see that coming. That ends up being, your edge in finding those markets and those opportunities, right?
For sure. Yeah. And I actually like, the commodity markets are, I find, to be a rich source of alpha because they often play in these sort of nice, concrete, long cycle dynamics. So if you can understand the supply cycle dynamic and then, get the macroeconomy demand side right, you can actually, you can do a pretty good job there in terms of understanding what the price moves are going to be. And, big picture is, those things are signaling higher prices ahead, not lower prices ahead, which if we go back to our inflationary story or inflation conversation, that's, they're not the only driver of inflation. We already talked about how services are such an important driver, but it's certainly a driver that will likely be a positive support to inflation over the next 10, 15 years. Whereas before, what we saw the last 10 or 15 years was a negative pressure on inflation from.
Mm-hmm. And I think kind of going back to our other conversation about removing risk, I think that also has a role to play in being able to take risk off the table for making those types of investments as well.
Yeah, for sure. That's a very important part of the story.
Yeah, absolutely. Excellent, Bob. Well, that's all I really have for you today. Is there anything that you wanted to leave our listeners to think about, or leave off with?
I think the main story that I think will be helpful to folks is really trying to understand the sort of income driven expansion. In a lot of ways, that income driven expansion is totally unfamiliar to most of us and totally normal in terms of how economic cycles sometimes play out. And so understanding that's the frame that we're in will be very helpful. And then thinking about, if interest rates rise or fall or stock prices go up or down, or, what is the likely second and third order consequences of that if you have that right framework in terms of thinking about what's going on with the economy.
Mhm. Absolutely. I think trying to understand those second and third order consequences is something that I constantly try and do, and constantly try and find the best thinkers in those cases to be able to really understand those secondary and tertiary effects of, just not looking at the base level of seeing, well, interest rates went up or interest rates are high or we expect a cut, right?
Exactly. You got to understand the dynamic behind the dynamic in order to really understand what's the likely consequence of those various shifts. And so I think that's that's the thing that many have missed. But if you understand the income driven cycle, you will have you will likely have an edge over the course of the next couple of years in terms of navigating this cycle.
Excellent. So for those that want any to check out more of Bob's work, it's all available at unlimitedfunds.com, and also excellent Twitter follow. He puts a lot of really interesting information up there at Bob E Unlimited. Bob, thanks so much for your time today. Really appreciate it.
Thanks so much for having me. It was a great conversation.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.